All right, we are live. My friends, welcome back to another episode of The Deep End. This is big number 30, man. Episode numero 30. All right, man, how are you?
I'm doing great, man. We're episode 30 is just wild. I mean, I can't every week you announce, what episode it is, and every week I'm like equally as blown away. But you know what? Honestly, it's such a blessing, and I'm very grateful. I want to start off with that because every video I've just been reading all the comments, and there's so much positivity out there. There's so many
Yeah.
investors that we're kind of filtering into this community, and we're all growing together. And that's what I think is the most epic part. And speaking of growing together, I do want to just go ahead and plug Blossom. We are powered up by Blossom, the #1 investment community that's out there. So if you're an investor, you're looking to get involved in an investment community and really be a part of something bigger than yourselves, check out Blossom, link down there in the description. You can also find Ryan's entire portfolio and mine transparently shared. Check out what we're investing into. But speaking of investments, Ryan, talk to me, man. We spoke briefly yesterday about a particular stock you might be selling.
Yeah, so I want to get into that. I know you've got a big milestone to share too. Before we get into any of that stuff, obviously we are recording this episode live in real time, unless you're listening to the podcast version, obviously. But if you're with us right now, this is live. And later on in the conversation, we'll go through your guys' questions. So any investing questions you have for us that you want us to answer here in the episode, just drop them in the chat. As they pop up here in the chat, I'll save them as we go along so we can revisit them later. But yeah, man, like we were talking about yesterday, just getting into it. And I almost can't even believe I'm about to say this, but as you know, it is earnings season right now. A lot of companies are putting out their earnings. And for the most part of my portfolio, it's going pretty good. For the most part, very good earnings. Visa crushed it. WP Carey, actually, which has been a sleeper, that one's done really well. A few other companies have done pretty good too. There's one in particular, not so much. This one company, and I want to jump it over to the chat. Send it over to the chat in just a minute and see if you guys can guess which one I'm talking about. But this one company, I'm actually thinking about removing from my portfolio. Let me know in the chat if you guys have any guesses as to what it is. Like I said, I can't even believe that I'm talking about this. I can't even believe that I've been thinking about this. Something I've been chewing on probably for the last couple of quarters. And as time has gone on, been thinking about it a bit more deeply. I hate it, but it is what it is. Yeah, Ron here says Rollins. No, if I don't own Rollins, I would never sell Rollins if I did own it, because that stock is just crushing it. Korean Cardboard says J&J, thinking about removing J&J. No, actually, I was pretty pleased with their earnings. J&J still seems to be chugging right along. One of you guys is going to get it. I'll give it another few seconds, but then I'll spill the beans. Let's see if anyone guesses it. I'm surprised no one's done it yet. Okay. I don't see it in the chat.
A little hint. It slid in terms of that stock share price within the last, 24 hours?
Yeah. Good guesses, though. Here now, Ron says KRC.
That's security company.
Yeah. Couple people here say Clear Secure. No. Chris actually here has it. It's Starbucks.
We do have a winner in there.
Yeah. So Chris guessed it. Believe it or not, guys, I am thinking about selling out of Starbucks, which if you've been following me for any amount of time, you'll know that's always been one of my favorite companies. And I still have so much love for Starbucks. I still love the company so much. But, if I take that hat off and try and be a bit more objective about it, I'm just getting to the point where I'm concerned about the safety of the dividend. The payout ratios, both the earnings payout ratio and free cash flow payout ratios, have definitely crept up as the quarters have gone on. I think in this most recent quarter, there were actually free cash flow negative, which doesn't bode well. And there's only so long a company can do that before the dividend is no longer sustainable. So all of that's to say, I'm just getting a bit concerned for the dividend. And I'm at a point with it where I'm thinking I may just be best off quitting while I'm ahead, and putting my money elsewhere. maybe not permanently, but at least for the time being. Like I said, I still love this company. But they're going through it right now. And I think a lot of the investments they're making, which is why the free cash flow is negative, is because they're making so many investments in labor and other initiatives within the business, remodeling stores and stuff like that. Because they're doing all these things, that's having a negative impact on the free cash flow. And I think those are the right things. And it seems like we're starting to see some signs of that paying off for the company. But like I said, I'm just afraid that all of that's like the dividend's going to be collateral damage and all of that. Um, and so I don't want to be on the receiving end of a dividend cut, even though I think they are making the right moves and the necessary moves for the long term. For the long term of the business, I think it all makes sense. But I'm not really feeling good about the dividend. And so it's got me thinking about selling out. Plus, on the top line, this was their sixth straight quarter of declining comp sales. So that's not looking too good, even though revenue was up year over year, I think about 4%. So there is still some revenue growth, but comp sales are down. Free cash flow payout ratios are up. Free cash flow is negative. There's just some bad stuff. I know that was a very long-winded way to describe all of that, but do you think I'm thinking about that the right way, Ari? Or wrong? Am I wrong?
I
Am I tripping?
personally tripping on Starbucks. No, look, I think that interestingly enough, I'll let everybody in this upcoming Sunday. The dividend stocks to buy now videos that I make. Starbucks is actually on the list for a stock
Really?
to buy, but situationally dependent. And I explain what I mean. And I recorded that video already, so it's ready to go. But when I mean situational dependent, I mean depending on what you're looking for in the investment. Now, you just mentioned something I think that's pretty key, which is that you don't want a dividend cut, any dividend cuts within your portfolio. And that makes sense. But I think on the trajectory that Starbucks is on, it could be an opportunity for the longer term investor. And I also see that there are some stocks out there. I'm not the biggest technical analysis guy, but you do get stocks like a Starbucks. If you do look at its 5-10 year chart, it fluctuates, man, between about $90 per share and upwards of $115, $116 per share, and it just stays within that window. And so also J&J is another great example. I used to do that with J&J all the time, buy it in the valley and ride it up to the peak, enjoy the dividends, come back down to that valley, buy again. And Starbucks is a similar play. I personally love Starbucks because of that iconic product, and it has a global, footprint, if you will. It's loved. And where I don't like it, and I do mention this transparently, I don't, that balance sheet, man, I don't like any companies that have liabilities above their assets. It's just as simple as that. But it doesn't mean, I'm not here to say debt is a bad thing, because based on, you're just alluding to it, right? Building out stores, remodeling, like there are necessities when it comes sometimes to using debt. So it's not entirely a bad thing. I just personally stray away from companies that have large spreads when it comes to the assets and liabilities.
Yeah, that makes total sense. And that was actually that's another reason that I'm thinking about making this move, is because I'm comparing their balance sheet now to others in my portfolio. And keep in mind, like, this wasn't as big of a concern for me prior to seeing kind of the negative trend in the free cash flow. But now that we are seeing that, the debt situation gets a bit more murky to me. But like I said, I'm looking around at other companies in my portfolio that have much more favorable leverage ratios, much better net debt to free cash flows, even in some cases like negative net debt. So they have more cash on their balance sheet than they have debt. Companies like Snap-on's one of those. Zoetis isn't there, but it's close to it. Williams-Sonoma is another one. And I'm not saying that I would buy a lot of
Zoetis
those.
almost made my list, but it didn't quite. I have other companies that I mentioned for the upcoming Sunday, but I saw
Okay.
Zoetis on my radar and I was like, Ryan,
Yeah. Oh, I'll be interested to see what other stocks you have on there. I'm actually kind of surprised to hear that Starbucks is on there, but for the reasons that you mentioned, it does make sense. I definitely think there is opportunity here for sure. But you're right, like it is totally situational. And like I said, I'm looking around the rest of my portfolio thinking now may be time. There may be other better opportunities to invest that money right now. But also, like you said, the share price is so swingy. Right now, it's in the low 90s. I think it's down a bit today. I think it's right around 90 as we're recording this. But man, it wasn't that long ago that we saw it get upwards of like $115, $120 a
115.
share. Yeah. And prior to that, it wasn't that long that it was at like in the low 70s. And so,
Yeah.
I'm also kind of thinking, mid 90s, 90-ish, maybe it wouldn't be a bad time to make this move. Especially if the financial trajectory keeps heading in the direction that it's heading in. I wouldn't be surprised if I got an opportunity to buy back in at a price that's even lower than my average cost right now, which is about $86 per share. Like, it wouldn't surprise me if things keep, if the turnaround keeps taking time and the same store sales keep going down and whatnot. It wouldn't surprise me to see the share price get back definitely under 90, possibly under 80. Who knows? Maybe even under 70, in which case it would be a great a great buy. So that's kind of where my head's at. We'll see. I'm not entirely sure what I'll end up doing, but the more I think about it, the more that I am leaning towards selling out of it. So
Look, I real quick, there's someone in the comments that just mentioned Badger Meter, and that's a very interesting company. I don't want to talk too much about it because
is that
it is one that's on
oh,
the list,
dude, there
baby.
you go. I just talked about
But
that one too. That's a great company, man.
it's a great company. I do want to jump back to Starbucks just to say it's interesting because, one man's buy is always another man's sell. And so
Yeah.
there is, in fact, opportunity with Starbucks, and it's a phenomenal company. It's built itself a nice product-worthy moat around itself. That you don't get a product like that people just love and enjoy the experience of having that Starbucks. And they have their seasons too, like their white girl season, if you will, with that pumpkin spice latte. Heck, I'll be a white girl for that, man. That's a great drink if you need a little pick me up. But when it comes to Starbucks, I think there is opportunity there, but it's situationally dependent. And I think you just have to know what you're getting into. I'm not afraid of dividend cuts. And actually, this is a pretty, I think, interesting topic to get into, whether or not someone should be afraid of a dividend cut or not. And, for me, when I think about a dividend cut, first of all, it's a necessity for the company to take care of what they need to kind of do patchwork, which means that, hey, if you're a loyal investor and you still believe in that product, but that company may need to pull, that dividend on you, well, how loyal really are you to that company? How well do you really believe in the future longevity of the ROI from that company? And that's really important, I think, to think about. But most importantly, when it comes to a dividend cut, is what, again, goes back to that growth over the long term. If they cut the dividend, what is going to be the potential ROI? And so it's not, for me, it's not all about the dividend. Like to kind of play devil's advocate to what you were saying before, you don't want dividend cuts in your portfolio.
Yeah.
I just don't want losing companies in my portfolio. And so if they have to cut that dividend, slash it, maybe take like this is a crazy one to use, but it's the example that's coming to mind right now. An AT&T. Yeah, they had to cut that dividend, right? They had to. But ultimately, doing that patchwork helped them over the course of the longer span of time. And I'm still not a fan of AT&T. I'm just using it to say, what, a 7% dividend when they cut it to like 4? It's still a 4% dividend, whatever the cuts were. I don't know the exact numbers. But I'm saying, like, I don't mind. I'm a dividend growth investor. So show me that you're going to get back to growing that dividend, and I'm still in love with you.
I think that's a totally fair assessment, and it gets into a broader conversation about dividend cuts. Because with dividend cuts too, I'm of the same opinion. It's not so black and white. It is circumstantial. But I do think if it were to happen to Starbucks right now, it would happen because of deteriorating fundamentals and deteriorating financials. Um, and so I guess even just beyond the dividend cut, the reason for it is I think more so what I take issue with. And I see that as, and not even take issue with, but am concerned about. And I see that as being different than something like WP Carey, actually, for example. They cut their dividend, when was it? Last year, a couple years ago now at this point. And it wasn't because the company was in distress. It was because they spun off a big chunk of their assets. And so by choice, they were fine assets. They just are moving in a different direction. And so I see that as being different, a different reason to cut the dividend than something like Starbucks cutting the dividend. So, but yeah, I totally see what you're saying. And that's where I get conflicted, is because I see it that way too. And I do think very highly of the company, but also something is telling me under the hood, things are not looking so good. And I also want to be investing in companies that are growing. And right now it doesn't seem like Starbucks is. I hope they will get back to it. But I don't know. I'm also looking around elsewhere at Zoetis or, I mean, shoot, even Procter and Gamble. But other companies that can offer more, both in terms of growth and also safety. So I'm trying to weigh those two things in my mind, and this is the hard part about investing, and it's even more difficult, as you know, because this is kind of like your Johnson and Johnson in a sense. It's even more difficult when it comes to companies that you really, really do like and have a big affinity for.
Well, it goes, back to this point of like, okay, why really did you invest into the company? Like, and yeah, like a prerequisite for me is that it dividend. Now, how big is that dividend doesn't really matter as much to me, because I'm going to tail on the end of saying that I'm a dividend growth investor. So anything from, just a sliver of a dividend, as long as they're going to be growing it over time, or the company in of itself is growing, I'm in. Like, show me the money, Jerry Rice style, and I'm in on the opportunity over the course of the longer term. And that's why I'm willing, to a company like Starbucks. Now, I'm not going to be, I want to make this abundantly clear, I'm not going to be adding it to my portfolio. It's everybody knows that my portfolio is 7 individual holdings right now, and my portfolio is going to stay as such. But I do think for the investor out there looking for a good opportunity with a quality brand name, at least we can say right now, that has, I think, a lot of future potential upside. How long have they been working now on some tweaks? I mean, they had to get back to basics, a year and a half ago or whatever it was. And Starbucks is always kind of trying to go back to basics. And I think when you have companies like Starbucks, the game is so simple that they overthink it. Like what you do is you sell phenomenal coffee. In some people's opinion, it's very sugary. That's what I think. But
Yeah.
but
So a
you
lot of
sell
people.
coffee
Well, go ahead.
and
Sorry.
an experience. So
Yeah.
you're selling coffee and an experience. That's what you do. You don't need to do you don't need to create crazy menus and all this other jazz. Like, you just do what you do and don't get greedy. And I just, that's something even in life, right? Like, the moment you start to do 10,000 things is the moment you're going to be a loser in 10,000 things. Just focus on 1 or 2 things, and it's the same thing for a company. You don't need to become the next, crazy, I don't even know what I'm aiming to say right now, but you don't need to have them all. You don't need to be the Pokemon guy of catching them all and being able to sell everything, jack of all trades. Do one thing, focus on one thing,
So it's
build
okay
that,
to.
sell that product, and you'll win.
So in other words, it's okay in this instance, maybe even preferable to be like a one-trick pony, you know? Or,
I think so. For Starbucks, for sure.
yeah. Um.
But I think when
Anyway,
you have, like, for example, if you go in a different direction, like a tech stock, like take like a Microsoft that just hit a $400 billion market capitalization, by the way. I don't know. What am I saying? What did they just hit?
they're over $1 trillion at this point.
4 trillion. That's what it was. What did I say? 400 billion. So I'm
Yeah.
doing all the work for the Sunday video. $4 trillion market capitalization. My bad.
Dude, you're giving away
But you get a
all your
company
picks
like,
for Sunday.
that's not on the list. It's not on the
Oh, okay.
list.
Okay.
Microsoft's not on. But
All right.
I'm throwing out Microsoft, giving them a shout out. But I a coffee roaster, you know?
That's true. It totally depends on the industry. It's like if Starbucks started selling quesadillas or something or tacos, it would be a different story than like Microsoft adding a different, adding cloud services on top of Microsoft Word or whatever.
Yeah,
Makes sense.
exactly. And so you just got to understand again what you're investing into and then why you're investing into it. Because are you willing to stay with a company through the ups and the downs, and everything in between? And now it's not to say you don't ever sell, because you'd be an idiot not to sell when you absolutely should be selling a stock. That's just, it's not hitting par for you. But it is to say that, hey, great product is still a great product. Yeah, they're tweaking some things. Could they still get it right?
I'm hopeful for them. I really am,
You
but
still gonna sell?
uh I don't know. I as we talk more about it, I'm and as we talk more about it, as I think more about it, I'm more inclined to sell it than hold on to it. Just because I just keep going back to what's under the hood right now. And to me, that's not looking too great, especially in relation to other companies that I own that are doing better. Um, so I don't know. I'm weighing it. I'll still think about it, but I will make a move on it sooner than later because the share price with this one moves pretty quick. So I think if I am going to sell it, then now, like, I need to make the decision fast because I don't want it to continue dropping from here and then be in a worse situation. You know what I mean?
I honestly would say that I think Starbucks should be, if someone's going to take a bet on it, for an older investor, not, just before retirement old, but someone who's looking for, I feel like, a little bit more reliability, which is even interesting to say because we're just talking about the balance sheet and we're talking about what the company needs to do. But what keeps me anchored to Starbucks is the product. You have a good product. That's all. Like, your company is around that product. If you can fix and put solutions forth to make sure that you do what you do with your one product, I think they'll be fine.
Yeah. Anyway, man, enough about me and enough
Enough.
about this company. You have some pretty big news too in your portfolio.
300,000. I did
He
it.
did it.
And you know what? I looked back on Blossom. So if you're not on Blossom, get on Blossom. Because I was blasting things out about a month ago about $300,000. I'm going to hit it in a month and a half. And I'm a month in and I hit it. And I thought I wasn't, to be honest, there was some fear. There was some real fear there because I was like, oh, crap, I got to pay the taxes. I thought that was going to be like about a $12K tax bill. I was able to have that. So that's pretty cool. And then I threw that, in, and then all of a sudden the market popped and boom, there I am, above 300,000. Just before we jumped on here, I was at 301,000, a little plus from there. And it feels good, man. It feels good, but it's going to feel better by the end of the year, hitting 350, baby.
Oh, I thought you were going to say 400.
No, I don't think I can pull that off. Unless I'm like, throw everything in some crazy Starbucks or opportunity.
Dude, wouldn't that be crazy just from here, like after this conversation through the rest of the year, it's another 33% gain for the stock. Oh my gosh. That'd be insane. We're in a pretty loopy market as it is, it seems like, but that would just be the icing on the cake.
We'd become the Jim Cramers of podcasters.
Yeah. Yeah. I think we should try to avoid that. But man, congratulations. That's an incredible goal. No doubt that you were going to hit it. I actually thought, for some reason, I thought that the end of July was the deadline, but it was probably actually a couple weeks from now, huh?
Yeah, I just said basically whenever I posted, I said I'm gonna hit it in a month and a half. Like that's what I wanted to do, and I delivered in a month. So under promise, over deliver, if you will. Like I still have half a month to go and to load up that account, and tomorrow I'm gonna make a big deposit into the brokerage, into the settlement fund. At least I don't know if I'm going to buy anything. The market is. Can we talk about the market real quick? I mean,
Yeah,
we
absolutely.
we are literally on Everest right now in
Yeah.
terms of the market climbing. How do you feel about that? Are we emotional? Are we like it due for some volatility? What do you think?
I think so. I think we're probably due for some volatility. Like I said a moment ago, it's just loopy. It's just loopy. I feel like it's I don't know, man. I feel like things have been too good for too long. Um, and I think there's a lot of overconfidence out there right now. And I don't know. I'm interested to see what happens next, but something's got to give at some point.
I agree. I don't know what it will be. We just had the interest rates that are going to remain as they are. Of course, there's a lot of pressure from Trump that
Yeah.
really does nothing at the end of the
We
day for
actually got a
Powell.
question about that. I'll put it up on the screen.
Yeah, I did see this. Look, from my standpoint, I think Trump is a loud dog. I'm not here to get political. Like I'm just saying, like let's just make a truth a truth. He makes a lot of noise, but is Jerome Powell also ultimately going to just step down or do what Trump says? No. So I think we have to just take a look at that and realize that our current reality is Jerome Powell is pretty steadfast in doing what he has been doing, which is keeping rates as they are, at least, for the time being. And so what I think that does for all of us is it actually delivers through on a level of clarity and certainty. And that is actually helping to fuel the market. Now, what
Hmm.
would put us in, give us some jet fuel would in
Yeah.
fact be what Trump wants, which is to cut rates. With the obvious, right? But that I don't think that's a wise move.
Yeah, it doesn't seem like, I mean, based on the market performance, it doesn't seem like we need it. Exactly to your point, the market's doing just fine by holding rates where they are. And I would rather see share prices go down in the short term than I would see than I would see inflation go back up and have to reel that back in again. Um, so I think I have no issues with it whatsoever. Um, but yeah, I'll just leave it there.
Look, I would foresee, and by the way, Trump is also, I mean, all his tariff deals are now coming in, and it's all just coming together, really. And so I just think it's interesting, man. I had posted something on Blossom a couple of days ago, which I just thought was interesting, and a lot of people always post stuff like this, but I went kind of year by year, and I just post like the big events of that year.
Yeah.
And at the end of the day, like if you're an investor who's waiting and timing the market, you're going to lose because all of these quote unquote negative events and tariffs were in there for this past year, right? Like everybody was so freaked out about tariffs and this is the end of the world. But here we are, man. We're doing fine. We're soaring. And so like bet on America, as Buffett would always say, but that's the truth. You can't live your life teeter-tottering on whether or not something could or maybe won't happen. It's crazy.
Hmm. With that said, it's hard to imagine what could change the direction of the market right now because like you're saying, it seems like and there's always been a lot of moving pieces out there, but it does seem like a lot of things are falling into place. So I'm just interested and we're getting maybe some more certainty back in, which is what's pushing things up. But yeah, I would just be so curious to know like if and we can't predict it, but I'd be curious to know if the market were to go south and we were to see a pullback, what would cause that? I just can't think of anything at the moment.
I mean, another global crisis or war happening would rock the market pretty hard, I feel like, but that would be temporary. And so that's also important. It's like a lot of these things are just temporary, and can you sit and weather the storm? That's all you have to do is be able to sit and weather the storm. And you know what? More that I think about saying that, it's just like your umbrella that's going to allow you to like actually enjoy the rainstorm is
Yeah.
the portfolio that you build.
Hmm.
if you want to be a risky investor and start using, or betting on penny stocks and meme stocks and all these crazy stocks that don't have, real quality products, names behind them, balance sheets and everything else, I mean, you're not out there with a good umbrella. So that rainstorm is going to be pretty wet for you. It's not going to feel so great. But I feel like for me, okay, so, the market goes down, which is actually what I want, because I'm about to, like I said, probably about to throw in about $12,000 to $15,000 into my portfolio this upcoming week.
Wow.
Yeah,
Where are you
I
going
work like a
to?
dog.
Oh, sorry, man. I totally cut you off. My bad.
No, you go ahead. What was the question?
I was going to ask where do you, couple questions actually. This is a two-parter. Where do you plan on deploying all of that money? And also, I'm sure since we last talked to you, but you put a decent chunk in to hit that 300K. Where have you been investing your contributions this last month? And where do you
I'll
plan
tell
to
you
do
where
it
I haven't
from
been
here?
investing right now. United Health.
No.
I just saw someone mention that. I just wanted to share it. I'm not selling United Health. I'm a long-term bull on United Health, and it's definitely going through its fair share of problems right now in the spotlight. Mixed earnings it just had. On top of that, it's under investigation from the DOJ. So, I just think it's really going to take time, and I think what we're looking at is, like I always say, it's the largest healthcare provider in the United States. And I think that just gives it some real power to, over the long course of time, remain in the game. I'm not going to be buying more of it. And that's actually because of a new, you know what? I'll talk about it now. A new strategy I wanted to just put forth. And I just fundamentally believe that our future is obviously heading in a very technological driven future. So I'm like a mega bull right now on technology opportunities. But I'm also not the biggest fan of researching tech stocks. And so I'm actually, just continuing to double down on a broad market tech ETF. And, if everybody wants to get out on my portfolio and what it's looking like now and about to look like, you check out Blossom. There it is for everybody, right? But I just, man, I'm really bullish on tech, man. And I've fallen in love with understanding just like AI and quantum computing and where we're going with that. So what does that mean for my portfolio? My 7 stocks remain my 7 stocks. But I'm going to go even more technology focused. And I'm going to, again, all based off my investor profile. And I don't want anybody out there following me because you think it's a good idea. I want you to do you. I want you to understand your own investor profile. And I want you to understand your own risk tolerance levels. And I want you to bet on the future of whatever you think the future is going to be, because that's your thoughts. That's really important for me to stress. I personally think we're going to continue to head down this direction, and we're going to see a lot of momentum continue to pick up in the tech sector. And so I want to be a part of that. I don't want to play it right now as safe with the S&P. So Ryan, I thought about actually selling a chunk out of the S&P and putting it into the tech sector in and of itself.
Okay.
Not a crazy chunk, but maybe like another $25,000 into the tech sector.
So what is your weighting? What is your S&P weighting versus your tech ETF weighting? And how would you, if you were to change it, how would that change?
The weighting right now is 31% tech, and then that's the tech sector, and then I have 28%, I believe, right now is the S&P.
Okay.
And
so you might go down like 22, 23% S&P, maybe even down to 20%, and then that would put you at about 40%.
Look, I have time to make it up, but I'm not worried about time to make it up when I realize that tech is the future. Like that's just that's what I think, right? We're not going to slow down anytime soon. I was having a fantastic conversation with someone yesterday about technology, and hear me out on this, and then I'm going to toss you a follow-up question. It's a
All
little
right.
crazy, but I'm a little crazy, right? So I personally believe that, you know, we always look at the companies that were once in the S&P that are no longer in the S&P, right? But I feel like we have a new era of stocks, and I feel like everybody's always saying, "Oh, this is a new era of stocks," and you know, it's to our age and our time. But when you take like a Kodak, right? Like Kodak was kind of dying out. Yes, they didn't innovate, but the real deal with like a Kodak or any of these other companies out there that faded out was that they failed to see that where the future was really heading. And I feel like lessons have been learned by some companies out there, our Apples and Microsofts and Nvidias and these companies that are on the pioneer end of tech. And we do understand today, like you look at a company like Amazon, man, Amazon is innovating every freaking day, trying to create something new, and they have all the capital in the world to do it. And so I'm not here to say that Amazon is forever going to be, or same thing with Nvidia and Apple and Microsoft in the Mag 7. We might get a new, you know, top 5 or Mag 7, whatever you want to call it. But I am here to say that I think these companies will be here for the much longer term than, say, the Kodaks. And that's just because of the direction of the future that we are currently heading in, which is technologically advancing at a rapid pace. Like, think about just in the last 10 years, what we've seen. You know, I've watched from 15, maybe 16, 17, whatever, 17 years ago, having a chunky iPod to having a slim little iPhone, you know, like
I got something
that's
for you.
crazy. Oh, you have the original?
Keep talking. I got you.
Oh yeah, that's what I'm talking about. We went from that original. That's not even the original, is it? It is. I think it
No.
is.
I mean, it's an
No?
iPod Classic, 120 gigs.
Wow. You
Man, I
still
got
run
about.
with that?
No, I miss the days where this was it, though. I am so nostalgic for this thing. I love this, man. Love it.
Do you remember the days of running with a CD player on you? You know,
I think that was a little before my time. I wasn't into. I mean, I had
you
CD
weren't into
players,
it?
but I wasn't into running at that time. No.
Oh, man, I got 3 older siblings, and I would go out there and run, and I would carry this just this big, you know. Could you imagine? But look, we've come so far, and we're just at the beginning. That's my honest thoughts. And so there's someone actually out that just said, I already have a tech ETF. How
Yeah,
do
I
you
was gonna pull
feel
this
about
up.
adding individual tech stocks? I
Yeah.
love it. That's how I feel about it. I freaking love it. And I
See,
think you just have to find the tech stocks that you believe in, man.
see
Ryan's getting
that.
worried.
No, 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 no. I'm glad this question was asked because I was actually going to ask you a very similar question. So I've been doing, and a lot of you guys have probably seen these. I've been doing these like daily portfolio reviews, just these short, 60-second videos. They're all Blossom portfolios. But one thing that's been very common with these portfolios is that I'll see, you know, a couple big positions being like the S&P 500 and QQQ, which is fine. Like that's great because a lot of these guys are actually younger investors, which I'm very stoked to see. Like 16 years old, 19 years old, 20 years old, um, and a lot of these portfolios do have those type of ETFs as big weightings in their portfolio, which is obviously pretty tech heavy as it is. But then it's pretty common to see if they have individual companies to see those individual companies, which are also big positions typically, be companies like Nvidia or Broadcom or Alphabet or Microsoft, the usual suspects. And I don't know, when I'm doing when I'm reviewing these portfolios, I kind of take the opposite approach, not because I think they're bad companies or yeah, not because I think they're bad companies. I just feel like it's almost too much overlap. And so just for the sake of simplicity, I don't think you need to have them when you're already probably buying them every single week and have such large exposure to them through these other funds. And so on one hand, that's how I feel. But on the other hand, I also do see your point of view and probably Korean's point of view here that questions, well, okay, well, what if I want more exposure to them? What if I think that highly of them that I just want more exposure to them? And I think that that's fair too. And I don't exactly know how to reconcile those two, but I think when it all what it all boils down to is if you do feel that way and you have good reason to want additional exposure to them, then by all means, do what you think is best. I think where I take the opposite opinion, especially in these portfolio reviews, or the reason that I do so is because a lot of these people are brand new investors. A lot of them, like 16 years old, 13 years old, they're just getting started with this stuff, and they're just getting started with this stuff. So I have a hard time believing that they have such high conviction to make that type of decision. And I could totally be wrong. I have no actual basis for suspecting this. It's just, I don't know. I could be wrong, but I think that they more so make that decision, that portfolio allocation decision, because they just see so many people talking about Nvidia or Alphabet. And it's just like, it's just a thing you do. It's just the thing you're supposed to do. And they don't really question it beyond that. I could be wrong about that, but that's where I settle with those. Does that all make sense?
Yeah, for sure. Ryan's the bully on the financial playground.
I hate that. I don't want to be that at all, but
He's picking on all the 13, 14, and 16-year. He's like, you
I
guys
know,
suck at
dude.
investing.
It's so funny. It's so funny that you say that, because when I'm doing, it's just circumstantial that it's just circumstantial. Like, I get tagged every day on Blossom. Hey, Ryan, review my portfolio. Hey, Ryan, do it. And I love it. Like, send me your portfolios to review. I'm happy to do it. But it just so happens that a lot of them are these younger guys, which I'm happy about. But yeah, it totally feels that way. And I've thought about that too. Like, someone's going to say at some point something like that. Why don't you pick on someone your own age,
Yeah. Why don't you pick on someone your own investor profile,
I know. I feel like now I feel like such a jerk.
No. Look, I think what's important, if these kids are, and I've seen your videos, man, they're good to watch.
Thanks,
and you can
man.
learn a lot from them. So if you haven't seen, Ryan's video, I think you're posting them on YouTube, on Instagram as well. So you have a fair amount of opportunities to watch these videos.
If you're looking to cringe yourself out,
particular,
if you're looking to cringe yourself out once a day, just go to my YouTube channel or my TikTok.
Well, you can start to stand up to these kids who are getting harassed and bullied by Ryan by commenting.
Yeah.
But look, I think with these kids, I mean, they just better be sending you these portfolios to actually then implement your feedback, because you give good feedback. And, to your point, I'm not a fan of investors tossing money into individual stocks until they actually build foundations. And I don't really care if those foundations are in the S&P 500 or in a tech-oriented ETF, but give yourself something stable and reliable to at least build on. And I think that's really important before you just get gung-ho about, individual stocks with the higher potential to lose your money if you're not actually looking into these companies. And I was walking with another fellow the other day, and he was telling me, he's like, man, my brother was watching YouTube. This was actually kind of funny. He's like, man, my brother was watching YouTube the other day, and he told me he was getting into finance. And so he sent me a YouTuber that he started watching, and it was you. I was like, oh man, I don't tell my network that I'm on YouTube. So that was pretty funny. And he was like, I couldn't believe it. But he goes, man, how do you do it? Like, how are you investing in stocks? Like, it's just so boring to me. And I said, well, that's exactly it. I said to him, if you find it boring, you shouldn't be doing it to make money. You should be investing into individual stocks. The kind of process of looking at these companies and their balance sheets and their, the financials and how they're operating. And if that's not you, then just stick to the S&P 500 or stick to an ETF. That's what they're there for. And I think that was really important. But again, a lot of these kids throwing money in because they're all trying to get rich. They're all trying to get Instagram rich, or be flashy. And I think what everybody needs to do is build that foundation first.
Yeah, I agree with that. And I think that goes back to what we were talking about earlier, what we were asking earlier about the market from here. Like, I think part of the reason that it's so easy to just put money in those type of things is because things have been so good for so long. A lot of these newer participants don't realize that things can go the other way. And I don't know. I think that's part of it too, is these, even though, even though there's no denying that technology's, pretty much everywhere and everything, and it's going to be an increasingly more important part of our futures. And so these companies should be better off because of it. At the same time, they've run up so much. And I mean, Microsoft's actually another example of that. Nvidia for sure. And so it's hard for me to get, even though I think they're good companies, it's actually the same thing with Costco too. Not a tech stock, but same thought process. It's hard for me to want to pull the trigger or advocate for pulling the trigger on them now after they've just seen such tremendous gains, especially if the person doing it is someone who's like just getting into it. And once again, it's just looking around at what other people have and what other people are doing, and just seeing that as, well, that's just the thing you do. You buy Nvidia. That's the thing you do. You buy Alphabet. Okay, you buy Microsoft and Costco, because that's just what people are doing. So I don't know. And it's obviously like there's no black and white, right or wrong answer. There's so much gray area here, and I could be wrong about some things. I could be right. Same with Ari, but that's kind of where I settle on all of this.
When I worked at Tip Ranks, I had in my office a whiteboard that people wanted me to write down my stock ideas of the week. And there was one of those weeks I had written Nvidia on the board, and I wrote the buy price, and I had people swinging to my office, and they were like, well, let's see the whiteboard, and there was one woman in particular who came in, looked at the whiteboard, jotted notes, and the next day she came in, she's like, my husband and I bought Nvidia like up the wazoo. And I was like, oh, that's great, and about a month later, like, Nvidia was soaring. And
yeah,
I was like, crap, like I should have bought Nvidia, and I didn't. But about a month later, after that month, it was still going up, and then it was still going up, and it was still going up. And so who really lost out was me, because I'm like, oh, I shouldn't buy, it's going up, oh, I shouldn't buy. And so you also got to factor in that, like, if you're looking at a great company and a great trajectory, it's not a terrible idea to ride the upswing, and to at least jump on the train. But again, you gotta be careful with that. And I want to make sure that I'm putting a cautionary flag when I make that statement. Now, I ended up buying Nvidia more recently when it dipped. And I'm already up, about 1,000 something change on Nvidia. I didn't buy a crazy amount of shares, but I just, again, take the opportunities when they're there, and kind of just go back full circle. Why buy individual stocks after you already have them in, whether it's the S&P 500 or a sector ETF? Like Ryan said, you do want maybe more exposure to a particular opportunity. And if you're really bullish on one of those opportunities, but you also want a hand on the sector, I think that is a wise move.
That's fair. As I like to say, more than one way to skin the cat. There's definitely no right or wrong. At the end of the day, I guess if you're making money, then who are we to say that's wrong? Because that's really what it's all about. I do want to touch on this point right here from Michael. It's a good comment. He says, I don't think the price of a stock should be a factor. It boils down to the growth percentage, whether a stock is cheap or expensive. And that's totally true. But I'd like to remind you that growth is a component of the value that you're getting. If a company's growing pretty aggressively, like a lot of these ones are, then there's a lot of value to be found there. But price is a reflection price is kind of a reflection of that. If all of that value is already baked into the price, then it's really not a good value, no matter how much growth the company is seeing, because it could already be factored into the share price, in which case you're not necessarily getting a good value. So price definitely does matter. But also so does your time horizon. the longer, to your point too, Michael, like the longer time horizon that you have, the less the price today probably matters. And I think, that kind of just goes back to what I was saying with these young kids and kind of like nips that in the bud. A lot of these young kids, whether they're 13 or 16 or 20, that are, making these decisions, man, they have so much time on their side that, yeah, Ryan, even probably buying today at all-time highs, if these companies continue to be good companies, um, even buying today at all-time highs, they'll likely be just fine. So, once again, so many different angles to this. This is like the complicated thing about being an investor, but it's also, I think, one of the things that makes it fun. It's fun to think about some of this stuff. But I feel like we could go in circles about this exact thing. We do have a few really good comments here that I think we should get to close out the episode, if you're cool with it. This first one, Ari, man, is for you from Janice. This one's right up your alley. How does one understand an investing profile?
Ooh.
Like, how do you decide what your investing profile is or should be? What are the factors that you need to consider?
Yeah, great question that I don't think the vast majority of investors even know of or even ask themselves. So first of all, the investor profile is who you are as an investor. If I had to kind of dumb it down and define it as such, and the factors that go into your investor profile come down to your age, first and foremost, which gives way to your timeline. So let's just put that in full swing. If you are 20 years old, that means that you have a, again, now depending on your goal, because I want to throw that in as well. But wow. Thank you so much. Incredible. Wow.
Alfredo, thank you, man.
Such a distraction, Ryan, to throw that on the screen.
Alfredo with the $20
man,
super
Ben and
chat.
Jerry's ice cream.
Nice. Thank you, man. You didn't
I
have
got
to
a
do that.
Ben and Jerry's cookie dough. I'm gonna go buy another pint. Thanks to Alfredo.
I might forgo the McNugget and go to In-N-Out Burger. Had that last week for the first or second time this year, and oh my gosh, I didn't realize how much I missed it. Ugh.
Really? Yeah, I can't eat that stuff anymore, man.
Oh, I typically am fine staying away from it, but dude, it was so good. And then later that afternoon, I hit a 10K run. It was like, it's such good fuel for that run. Anyway, go back to the investor profile.
The investor profile. All right. So, you got to take a look at your age, which gives way to your timeline. And just knowing that, if, for example, I'm 30, I got another at least 35 years of solid, work in me, that if I really needed to go out there and get a job and slave away in a career, I can do that. And so you got to factor that in, because I could take on more risk than an investor who's, say, turning 60 and really can't afford to take the big risks that I can take. Now, an investor at 20 can take more risks than I can. And so you just have to factor in your age in that timeline. Now, the other big piece of this for an investor profile is, and this is where everybody's really different, and it's so subjective here, your risk tolerability, or your comfort level when it comes to risk. It doesn't matter at the end of the day if you're 20 years old, if you're terrified of, investing in an individual stock. Well, that's going to limit you down to then, ETFs or mutual funds or whatever you're investing into. So that is also a major factor in how someone invests and putting together their investor profile. I think another key element is, well, how much money can you throw in? And this actually will go back to the last question that we had on the screen. Price is what you pay. Value is what you get, is the famous saying. And it's a great saying, because I often see a lot of investors saying like, oh, that stock is so expensive. It's trading for, I don't know, $150 or $200. Can you start talking about stocks trading around $50? And I'm like, I can. That doesn't mean they're higher quality or they're gonna grow and appreciate more than the $250 stock. So that's also a factorization within that investor profile. But those key elements really are your age and your risk tolerance, and that tolerability or comfort level, right? And you really have to factor that in as an investor. Now, finally, at the end of the day, no matter what, as long as you're in the market, then at least at some level, you're doing it right. Like how you're at least, even if you're losing, this is a bold statement, even if you're losing, at least you're in the market. And I still say you're winning because you're hopefully learning.
Yeah. I don't know if I can add anything to that, man. You're the master of the investor profile. And
I think I
if
talk
you were,
about it every video.
yeah, well, and rightfully so. If you weren't going to mention kind of like the sleep well at night component to it, that's probably something I would have added. But I think it's pretty much just come down to those few things, right? It's a balance of your age, your and your risk tolerance, and time horizon and ability to
Your
contribute.
goals as well. I'm sorry, I completely
Goals as
forgot
well.
about that.
Sure.
If
Yeah.
you're buying a house in 3 to 5 years, you probably don't want to be in more aggressive stock opportunities. And, again, if you don't have any major purchases coming down the pipe, and you are younger, I mean, that the goals also factor in. That was the third leg. I don't think I mentioned. I think I started to mention it, and then we talked about Ben and Jerry's ice cream and In-N-Out Burger.
Once you start talking about food, everything else just goes out the window.
Yeah, man, I'm stoked, man. In about 4 minutes, when all this is said and over with, I got the next, the half of my pint I didn't eat yesterday of Ben and Jerry's.
Is it that I think you like the espresso type flavor, right? Or is it
That
some
was
different?
last week, my friend.
Okay.
This week we're going cookie dough.
Oh, there you go.
Yeah, I try to, I once a month get cookie dough because I love it, man. I love it so much.
Yeah.
I could eat the whole thing, and I just
Oh yeah.
yeah. I try to treat myself that way though.
So we've got a couple more questions. I thought this was an interesting one. Fast Eddie says, if there was a scale from 1 to 10, 1 being grandma putting her money in a coffee can, and 10 being putting it on a roulette wheel, I see Ryan as a 4 and Ari is a 7. What do you guys think? So first and foremost, I think that we need to do away with the number 7 on these 1 and 10 scales because it's a safe number. 7's too safe. Like 6 says a lot more than 7. 8 says a lot more than 7. 7 doesn't really say anything. It's too moderate. Let's exclude 7. Where would Ari go without 7? I don't think he'd be an 8. I actually think he'd be more of
You
a
don't
6.
think I'd be an 8?
What are we?
Man, I
What are
gotta
we
up
measuring here? Are
my
we
tech game.
measuring? Are we measuring risk? I mean, I don't know, man. I don't
Yeah,
personally see. I don't personally see like putting the most of your portfolio in like broad ETFs or, ETFs, just diversified ETFs in. I don't see that as being super risky. It could be volatile, but I don't think that's a super risky thing.
Yeah, no, he says he's talking about risk, but you know what, Eddie, I want to say that I think Ryan is going to pose a bigger risk than I would here, putting his money in a coffee cup, and it wouldn't be making anything. Actually, it'd be losing money over time. So that's the bigger risk here is our grandma Ryan.
Yeah, I think what he's really saying when you get to the root of it is you're maybe just more aggressive with these holdings. I'm more conservative, and if that's what we're measuring, I think that these would be pretty fair assessments for sure. But also, like, I want to give myself a little more credit. Not credit. I want to have the chance to weigh myself a bit differently, if you don't mind. If I had all of my portfolio in Procter and Gamble and Johnson and Johnson and stocks like that, yeah, I could see that being like a 4 below. But man, some of my biggest holdings are companies like Visa, like Zoetis, like Williams Sonoma. I mean, Realty Income's pretty conservative. That's a bigger one too. I also don't have a super small weighting to the S&P 500, so it also Clear Secure. Let's not forget about that one. So I get a lot of slack for being maybe slow and boring, but I've got some sneaky growth monsters in my portfolio as well too. And I think that's often forgotten about. And also Snap-on. And also I want to make one point clear, just because one doesn't have a certain exposure, a certain percentage to tech doesn't mean that they're not seeing growth in their portfolio.
I'm happy you mentioned that because actually, just to go back now real quick to Badger metering, dude, did you know in the last
example.
5 years, Last 5 years, it was 245% worth of appreciation.
Yeah.
That equals out to some tech stocks out. I mean, again, you could take like a Walmart is another good example that people are more familiar with. And people don't think that Walmart shines like a tech stock, but it does. It performs like one. And you just wouldn't think that. And so I don't think, again, some people mentioned it there in the chat that Ryan is necessarily safer by investing into the only dividend stocks. And I don't think it makes me more risky per se that I will, dabble with some tech. I think where risk comes in is like you start to gamble and speculate. Speculation is risky. So I like what David Clark, our friend here in the chat, David Clark says. He actually questioned, how is Ari risky? Because if you really think about what I'm investing into, S&P 500, I got the tech sector, and then I have stable, high quality names from certain sectors. United Health being from the healthcare sector. We got Google and Apple, tech sector. And so it's not like I'm playing penny stocks. And I think that's really important to think about. And it's not like Ryan is definitely not playing penny stocks, right? So it's an interesting question, though. I think what appears to be safe or risky is not necessarily always the reality.
Yeah. Maybe let me pose this in a different way. Maybe this is the difference. Maybe. I could be wrong. It's possible that Ari goes more for upside potential, where I possibly go more for downside protection.
Yeah. Capital preservation.
Yeah. But also that doesn't make you more risky. It just means you're willing to take on more volatility more volatility. So maybe that's the difference. I don't know. Fast Eddie also says, I won't buy a stock unless, I being me, won't buy a stock unless it pays a dividend, which is totally true. And that does eliminate a lot of stocks from my investable universe, but I'm totally fine with that. I don't need thousands and thousands of different stocks. I just need, a couple handfuls of some pretty good ones.
And to this, there's a comment there, just talking about, you just pulled it up. I might get some good hits, right? And I do. I for sure do. Google soared, and I literally saw this pop in my portfolio. But you know what? When volatility strikes, I'm down. When we just had this major dip, man, I was down almost $30,000.
Yeah.
And some people might sweat with that. I was walking in the park. I was like, man, I wish I had more money to throw in right now. So, that's my mindset that we're now talking about, which is in fact the investor profile, right? It's that risk adversity.
You know what, man? And this was a great comment. I love the end of it too. And I so appreciate, Gabe, that you think of us both that way. How do I say this? I think that difference, if I'm right on that difference, or if we're right on that difference, where one is downside protection, one is more upside potential. And it's not all or nothing either. Like that's a spectrum. And we're somewhere on it. But if that's true, I think that's what makes these conversations so interesting. And I think that's why it's so much fun to have these. And that's where the different mindsets come into play. And I think with that said, taking it one step further, if hypothetically we were ever to start a deep end portfolio, right? I think it would be really interesting to merge those two strategies, into one portfolio. And
we could do it. We
totally could
do
it.
Just start a portfolio and see how these stocks perform. It doesn't have to be, real money.
Yeah, that's true. I think that'd be really interesting, to build a portfolio combining these two opposing ends of the spectrum and just see how it does,
I like all the analogies coming in, man, like Shaq and MJ. That's great, but it is the truth. You know, you do need different players on the court in order to ultimately win.
Yes, absolutely. Absolutely.
And
Um,
there's one last question. I don't feel right eating my Ben and Jerry's without having Alfredo's question answered, especially because he threw in a 20. So, all right, quick question. If you guys can get to it before the end of the stream, which we will do right now, how would you help your parents invest if they were in their 50s and had 120K-ish to invest? Ryan, you want to take it away?
I would be so scared, to be honest, to tell my parents where to put their money. Um, so I'm guessing that they have probably 10 to less than 2 decades until they're able to retire. It would help to get a little more color on like their situation actually, but assuming that they are closer than they are far from retirement, probably this is where it gets tough. Okay, one thought at a time, Ryan. I probably would lean towards something with less volatility, something a bit more protective of that money. Um, but at the same time, if let's say hypothetically, this is their first entry into the market, this is their first stab at building a portfolio to retire on, taking that approach is also it's going to make it difficult to retire, I think, in the timeline that they're probably looking for. If they're just putting in that 120K and letting it ride, I think they would need more time than 10, 15 years for it to grow to where they may feel comfortable retiring. I could be wrong about that, and it totally depends on what the market does. But um, I don't know. I'm pretty torn. But I would, if this was me trying to consult with my parents, I would hate to be the reason that they lost their retirement savings or that they took steps backwards with it. And so that's probably the biggest reason, or a very big reason, why I would lean towards being more conservative, which is selfish. Like it's just a selfish approach to it. But I'd have a hard time overcoming that.
So I think it's a great answer. I think preservation of capital is going to be necessary. You can't afford to lose it all at this point. So that's incredibly important, and you do got to play conservatively. However, because of the objective here at hand and the dire necessity to reach that objective, you do have to put forth at least some growth opportunity. So how do you mix the two really? How do you get that fine balance? And I think this is where the S&P 500 actually really does come in. I do not think. By the way, I manage my mother's retirement funds, and so it's a great honor to do something like that. And I'm not. You got to be careful. You just do, because if you mess up, you're taking away your retirement, and no one wants to work well into their elder 70s to 80s unless they want to.
Yeah.
And my grandmother actually, she worked up until like 80 something years old, which she worked at Lord and Taylor's, and she loved working, and that's just her thing. But she didn't need to, and that's a different story. But let me just get back on track. I would play it ultra safe, and I would nibble at growth while playing it ultra safe. I would find myself invested in the S&P 500, and I did just run some numbers in a compound calculator, and I think this is really important. So we're starting off with $120,000. I believe, right? That was in the comment there. I think so.
Yeah.
120,000 they have. They're 50 years old. I don't know precisely how old they are, but let's just say they're 50 years old. That gives them about 15 years until the ripe old classic age of retirement. And then if we were able to pump their monthly contributions up to $1,500 a month, that is doable. That may mean that you need to actually start to budget right. Most Americans, most people do not budget correctly, and they unfortunately throw their budgets out the window when their emotions take over. You can no longer afford to do that. So $1,500, $1,500 a month will be contributed. Length of time here, we're talking 15 years. Now, estimated rate of return here. This is where it's going to get fun with the S&P 500, because we're going to go really conservative and just go by the law of averages for the S&P. We're returning about 10% per year. That's going to give us.
Isn't it? Go ahead. I'm sorry. I'll say what I'm going to say in a second.
That's going to give us over $1 million by 65. And is that enough? Well, I don't want to say you kind of screwed yourself by not investing earlier, but this is the financial constraint that people are going to be living under now. You might not be able to stay in the house you're living in now. You might have to downsize, but this is the financial responsibility that you owe you to make sure you cover your bases. And if I personally was in this situation, again, I like to be direct and hard. I don't really care about people's emotions that much. If you're in that position, you might need to get out of your house now. Your bills might be too high now. And so perhaps it's worth thinking about downsizing now to a more affordable living, right? We have living expenses tend to be one of the highest expenses. Think about, and there's not enough information here. I don't know if their house is fully paid off or what that situation is. And that's really important. But again, if the house is fully paid off and they do want to make some money, you, again, could downsize. You got to ask yourself a question. Do you have 3 rooms and you only ever use 2? Do you have 4 rooms and you ever use 1? You know, it's like, what are you actually using in that space? Do you have a backyard that you never even sit in? You know, like, what are you doing? Do you need all of it? That's a fundamental question. But you got to start. You got to start now, and it's totally doable.
Yeah, at that point, once you get into your 50s, it's like, even if you have 10, 15 years left, whatever it is, it's sounds like a long time, but in the world of investing, it's not. It's crunch time. And it's pretty incredible how much more you have to contribute then compared to if you had just started even 5 years before that. And the longer that you delay that, the more that you're going to have to contribute to make up that lost ground. And with that said, too, as tempting as it might be for someone who's starting that age to cut corners and maybe, try and take shortcuts and cheat the system, so to speak, as tempting as that might be, it's not a good idea. It's not a good idea. Even hopefully they're in good health and they remain that way. And if so, like 65, they'll still be not, as young as other people, but like they're still relatively young bucks. They could still be like 65 is the new 50, maybe not the best comparison, but you know what I'm trying to say. And so what the point I'm trying to get to is that they could still have a very long life ahead of them. Another good, hopefully 20, 25 years, if not more. And, there's still not, I guess what I'm trying to ultimately say is there's not a lot of time, but there's also, you do still have time to let compounding continue at that point. And don't take shortcuts. What I was going to say a moment ago though, man, when you were, pulling up the compound interest calculator, you said a conservative 10%. I just think isn't it funny? Maybe this is just me, but isn't it funny that now we've been tuned to think that 10% is like ultra conservative and supposedly like not good enough. You should expect like by default more than that. Isn't that something?
You should expect 20.
You should expect 20. That's something.
Yeah. I mean, look, I don't think this it is funny. What you're saying is certainly funny. And it's the expectation that we have today that, the market will continue to boom, but we're at a time and age where such rapid advancements call for what we're seeing. And it reminds me of a scene in the Gladiator. Have you seen that movie? Russell Crowe.
Oh yeah.
And he's in the Coliseum and he's like, "Are you not impressed?" And is this not what you wanted? So to speak. I feel like that's every investor out there, investing, and the market's just returning and we're like, oh, like, are you not impressed? And investors are like, we want more,
Man, I feel like that could be a whole nother conversation. I feel like if we get too deep into that, it's going to be a can of worms. But overall, really, really solid questions today. It's fun hopping on these live streams with you guys. We try and do one, at least one per month. I think this is our second one per month. We'll do another
Well,
one at the end of
let's throw this
August.
out there real quick, just while we're
Okay.
live. Do you guys want more live streams? If you guys
Yeah,
want
that's a good
more
question.
live streams, you let us know, because we're not here just for me and Ryan. We do this, off camera regardless. We're here literally to let you guys in on our on our thoughts, to let you guys in on the conversations. And if these are helping you more than our pre-recorded videos, then we are more than willing to schedule out these times to actually come on and do this live, answer questions, and be right here with you guys. I just keep talking because I'm waiting for that chat to fill up. So if you guys can respond.
Well, so far, yeah, I mean, it's 100% hit rate with the live streams. I mean, Fast Eddie says, I love the lives. Janice loves them. Michael is as many lives as we can do. Jake is on it. Cooper says live is better. So I don't know. And I'll tell you what, it really is. It's easy enough. It's just as easy to schedule a live and do this as it is to just do a normal recorded video. It's the same thing on our end.
Dude, if Alfredo's going to be throwing us 20s during the live, I'll even do a show with the cookie dough ice cream back here.
Oh man, you'll need a lot more than 20 for that show.
Yeah. No, I like this. It seems, Ryan, that we got to do more lives, and we will deliver. That's like I said, we're here for you guys.
Yeah. 100 for the ice cream show.
Only if you give it to your parents.
Yeah.
And by the way, I just want to make this clear, Alfredo. I got a lot of friends. I work in the financial space, so I got a lot of friends in this space. Advisors. If your parents want to talk to them, if they want to talk to Ryan or I don't know if I won't speak for Ryan, but you could certainly reach out to us and have your parents talk to us. I will be just as direct as I answered that question for you. I don't shy away from being direct with people. So sometimes it is worth having a direct conversation and, really kind of just giving someone a very objective viewpoint on what needs to be done. And it is hard. It's definitely hard to be a family member telling another family member what to do. So I'll throw that out there for you. We thank you for the 20. Make it 100 next time for the ice cream.
That's funny, man. But guys, this is a great place to wrap it up. Thank you so much for hanging out with us this last hour and almost hour and 20 minutes. Really fun. Who knows? Maybe we'll be back again next week for another live stream. Time will tell. But guys, yeah, thank you for all the support. Episode 30 was a hit. Might have been T-Boy, the best one yet. I don't know. But otherwise, we will see you guys in the next one. Hope everyone has a good day. A couple more hours left till the market closes. So I hope it's good to you guys. Take care.